Most systematic quantitative models fail because they feed raw equity returns directly into predictive engines, an approach that inevitably ends up collapsing into pure noise. Daily price movements for any individual stock are overwhelmingly driven by universally tracked macroeconomic forces. If you look at an energy stock, its daily price is largely just a reflection of the global price of Brent crude oil or the local exchange rate. Because these macro relationships are common knowledge, they are continuously arbitraged. You cannot extract a unique informational advantage by trading on data that every institution and retail trader is already watching. The only exploitable alpha resides in the idiosyncratic residual. This is the faint price movement that remains only after you dynamically, mathematically strip away all the known macroeconomic drivers. Finding a genuine edge, therefore, is not an exercise in better market prediction. It is a task of extreme noise filtration, isolating hidden anomalies that the rest of the market cannot see. Residuals present a two-part physical challenge. They are exceptionally faint, making them difficult to detect, and they are highly fragile once you actually trade on them. In a 2026 working paper out of the MIT School of Engineering, Marcus Bergo proposed a framework that treats the market as both a thermodynamic and information theoretic system. The central thesis is that mathematical inference, finding the signal, and market execution, trading the signal, are two halves of the exact same information theoretic equation. The framework demands a specific life cycle. You start with robust signal extraction, run those signals through a multi-layered causal validation gauntlet, size your portfolio with mathematical humility, and finally define the strategy's physical capacity limits. Deploying a successful strategy requires an epistemic engine to measure the precise dimensions of your edge, and a physical model to calculate exactly when the act of trading will destroy it. Extracting a pure residual requires dynamic modeling. Static hedging methods fail because the relationship between an equity and a macro factor changes abruptly during a severe macroeconomic regime shift or crisis. Historical correlations break down. This chart illustrates the dynamic solution. By utilizing a random walk Kalman filter to constantly adapt the hedge coefficients, the system isolates the true signal by subtracting the macro factors, leaving behind a faint residual waveform. But look at how a standard Gaussian filter behaves here. Financial data contains fat-tailed, extreme outliers. When a sudden shock hits, the red Gaussian tracking line overreacts and overshoots the actual trend violently, losing the signal entirely. To fix this, we apply a robust student T extension. A blue tracking line smoothly ignores the violent spike. It dynamically downweights extreme outliers to preserve the accurate underlying trajectory of the true residual. Because these pure residuals are incredibly faint, they are highly susceptible to statistical false positives. You have to verify that the signal is real. The framework subjects every candidate signal to a triple validation gauntlet. The first two layers are cross-correlation, which tests for linear association, and Granger causality, which confirms temporal precedence, proving that one variable actually moves before the other. The ultimate third filter, required for complex markets, relies on concepts pioneered by Claude Shannon. It moves beyond standard statistics and uses pure information theory, specifically transfer entropy. Transfer entropy measures conditional mutual information. It detects nonlinear information flows between variables that linear models like Granger causality completely miss. Any signal that survives this triple gauntlet is no longer a statistical mirage. It is a mathematically verified informational edge. A common machine learning assumption is that more data linearly scales to higher confidence. In reality, purely predictive models collapse under their own increasing weight. Markets are non-stationary environments. Every time you introduce a new heterogeneous data source, whether it's commodity prices or weather anomalies, you introduce a new layer of nested uncertainty. This equation is the n-depth Bayesian confidence cascade formula, and it governs the framework's internal probability. Each new variable, or API, adds a fractional confidence multiplier, represented here as CK. This accounts for the specific uncertainty and reliability of that individual data source. The mathematical outcome is strict. As the system ingests more variables, the effective probability exponentially decays, crushing the final output down from an overconfident 65% to a highly cautious 44%. This self-regulating property mathematically prevents the AI from falling into the overconfidence trap that ruins standard neural networks in live trading. This honest uncertainty propagation protects the system from catastrophic error, but it leaves it with individual position probabilities that seem far too low to profitably trade on their own. This creates an operational paradox. How can an autonomous fund generate returns if its own architecture crushes every signal's probability down to a near coin flip? The mathematical rescue is the binomial amplification theorem. Notice this grid. It represents 10 isolated trades, each with a severely penalized 55% probability of success. By aggressively diversifying across these individually humble bets, the probability of the total portfolio being profitable mathematically surges past 75%. There is a strict caveat for this theorem. The underlying signals must remain entirely uncorrelated for the amplification to work. To deploy capital into this grid, the system uses the fractional Kelly criterion, converting that penalized probability into conservative position sizes. Following critiques by economists like Paul Samuelson regarding the limits of maximizing geometric growth, the framework uses a correlation-penalized Kelly optimization. If crisis-induced correlation spikes are detected, it actively reduces position sizes to protect the portfolio. The system destroys individual overconfidence to survive, but it harnesses binomial diversification to thrive. The two mechanisms are completely interdependent. Assume the engine has perfectly extracted, penalized, and sized a valid edge. The next question is physical. Can you deploy unlimited capital into it? Here is Bergo's scaling law. It establishes a strict, deterministic capital ceiling, known as K star, for any residual strategy. The numerator isolates the boundary of the benefit. This alpha term represents the net informational edge, strictly bounded by Shannon channel capacity. The denominator defines the boundary of the cost. These terms represent the physical cost of trading, dictated by permanent market impact and volatility friction under the Allmore and Chris framework. The final mechanism of alpha destruction is information revelation. According to Kyle's lambda, the sheer act of order flow alerts the broader market to your private signal. Think of it as a financial observer effect. Trading is a measurement that alters the price, disintegrating the edge the moment you attempt capturing it. Standard attempts to circumvent this fail. Spreading execution out over time simply collides with the signal's natural decay half-life, and using options merely transfers the impact to the market maker. Capital scalability and systematic trading is a hard microstructural boundary. The market's finite liquidity acts as an unavoidable thermodynamic limit. This flowchart reveals the entire architectural loop of the autonomous inference engine in motion. The left side is the epistemic engine. It isolates nonlinear causal residuals and mathematically crushes overconfidence to map the true boundaries of your uncertainty. The right side is the physical engine. It recovers portfolio confidence through diversification and optimizes capital allocation directly up to the immutable microstructural ceiling. Systematic trading is ultimately the management of finite information deployed against strict microstructural physics. This closed-loop architecture stands in stark contrast to purely predictive deep learning black boxes. Those systems operate under the assumption that prediction alone guarantees profit, ignoring the physical reality of market execution. The ultimate ceiling on an autonomous system isn't defined by the complexity of its neural networks. It is defined by the depth of its mathematical humility and its respect for the physical limits of liquidity.